The Money Show. Personal finance.
Warren Ingram is our regular personal finance guru on The Money Show. He's a personal financial advisor. He is an executive director at Galileo Capital. You must be looking at markets with a bit of relief. Your clients must be looking with a little bit of relief. I suppose that relief that they didn't panic out at 37,000 on the all-share index. We're 10,000 points ahead of that right now, Warren.
Yeah, thank goodness. And I think a lot of people are looking at this whole market and wondering if this is the beginning of the big bounce. You know, is this the next big up leg? So I guess the market's laying the trap for the next leg. But you're right. For now, people are somewhat relieved and taking a breather.
Yeah, and it's nice to see, and we'll accept the gains that we see on the JSE. Now, the role of your financial advisor in this time, what is the job of the advisor?
I think there are probably a few jobs. The one, and it's I laugh about it, but it's real. Is they almost need to tell you to stop reading your statements, to stop following what's happening in the markets, on a minute by minute basis. Now that you've got unlimited time sitting in your home to look at everything, and probably also the same around the developments on lockdown and globally what's happening with COVID, because I think certainly what's happened to a lot of us is we've got into this major event that started with a really big health scare, became a big economic issue, and then became a massive market issue, and we're kind of tracking this this train wreck live, but not in slow motion. It's happening really quickly, and we're all trying to become medical experts and virus experts and pandemic experts, and then second guessing what psychologists are doing, etc., around what markets are going to do. And I think a good advisor in this time tells their clients to stop and take a breath. Close your computer, zoom out, go and read a book, or talk to your family, or do something, but stop tracking the markets, because frankly, a lot of the time there is nothing to do when markets are doing what they're doing. The volatility is just not a good time to start making big actions, I guess, or taking big actions, or even better, make no big decisions until things are a bit calmer.
2 weeks,
and I think that
2 weeks into a lockdown, a month into the beginning of a sharp market decline, probably the quickest market decline that we've seen in our lifetimes. What if you've not heard from your financial advisor over the last month? You haven't contacted them and they've not picked up the phone to you or dropped you a mail, even a generic one that says, "Dear client," or one of those nice, charming things that comes.
Dear valued client.
Dear valued customer.
I don't enjoy that. I think I think the job of an advisor in times like this is just to make contact and if nothing else, to tell you to do nothing, and to not worry, because your advisor is worrying for you and on behalf of you. I think that's it's a good sign if you're getting contact from your advisor. I think times like this, when markets are tough, that's when the good advisors earn their money, and when markets are booming and everything's going up, advisors can relax and let things unfold a bit more. But now is the time they should be in contact.
Okay, so they get in contact. What should they be telling us?
They should be telling you to stay the course, and certainly not to make major changes. I think I almost want to say that the negative here is they shouldn't be telling you to change everything. In the middle of this whole thing, if your advisor phones you and says, I woke up this morning and I really think it's time for you to sell all your shares and move to cash until this whole thing's over, I think your next sentence to the advisor is something like, goodbye, and that should be as long as your conversation is, because I think now is not the time. I'm hearing some horror stories from investors saying, I chatted to my advisor and they said, sell everything, or others are saying, cash in your whole retirement fund, keep it in cash, and then just send it out into the international markets. And any major change like that is just not a big. It's not a good call at all. I think it's, in all honesty, it should be a fireable offence. I think if I was living in a dictatorship, it would be a fireable offence with the firing squad. And I think the reason is that the markets, as you said, I mean the markets already bounced 10,000 points, so that's something like a 26% recovery from the lows. And looking through some of the rubbish that was going on social media from advisors, telling their clients to move to cash and go overseas. The one thing that's happened is the rand strengthened by more than 5% already, and the JSE's jumped 26%. So for some people, they've probably lost out on more than 30%, of their capital just by doing something at the worst possible time. And I'm fully aware that the market could well be in something that they call a relief rally. So basically investors stop panicking. They start thinking. Unfortunately, they become too optimistic too quickly, and they try and find every silver lining in any cloud they can possibly find, and things go up, and then they kind of hit reality again. It goes down again. So we might be in that kind of a cycle. And I think for advisors to be telling clients to make major changes in a situation like that it's really shocking. I think, and it happens in every big market crash. And advisors lose their nerve often before their clients do, and the clients are happy to kind of stay the course and get persuaded by panicked advisors into making changes, and that's really bad. I mean, that's just that's financial destruction that is permanent. And so, in all honesty, if your advisor is telling you to do that, time to either find your own guidance or find a new advisor.
2020 started and people were coining the phrase 20 plenty, and stock markets were hitting record levels. Nothing was going to detract. Growth was solid. The global economy was chugging along really nicely. There was no indication that there was going to be a catastrophe, which is usually the best time for a catastrophe to strike, and exactly what happened when coronavirus became a pandemic. Should we have known that this couldn't last? And, the fact that it couldn't last, fine. It's not supposed to have lasted for as long as it has, but it did until it didn't anymore. It's a really hard thing to make a call, to be calm and sensible when everyone around you seems to be making so much money.
Well, I think it's interesting. I mean, I think we probably, in the first sort of 6 weeks or 8 weeks of the year, we probably on just in these conversations on the radio, and I'm saying it, knowing that people can go and check, but I'm pretty sure we said it many times that the American market is expensive, the JSE is not, but the international markets are, especially the US. And just be careful. And I think, that was with zero foresight. That was with, absolutely no ability to predict anything other than just looking at the state of companies on the US market, knowing, that gravity eventually counts, not always straight away, but it does. And so I think, in a time like that, you should always be prepared in the way that your investments are structured for a big crash, a big market event. In other words, you need to know that you've got sufficient exposure to the stock market so that you get good capital growth when things are going well, but at the same time that you've got good exposure to other assets like cash, like bonds, like property shares, and that those are going to be diversifiers, not always in a nice smooth pattern, and certainly that's what we saw when the markets went. I mean, everything lost value, but that didn't, that pattern didn't stay. And so I think for investors who were nicely spread across the world, not just in one place and not just in one asset class, and were prepared, if they knew before the time, what one promise a good advisor should make you, they should promise they're going to lose you money from time to time. They can't promise you when, because otherwise they'd be, they'd have a crystal ball, but they should be telling you that so that when it does happen, you are prepared for that. And I think, it's too late to say to someone after they've lost 36% of their money, you should have known that was going to happen. That's not the time to tell someone. You tell them before the time. And that's, and I think that's probably another conversation to have with an advisor is, if someone's sitting there, looking at their statements and saying to themselves, gee, I know markets are a bit rocky, et cetera, but, I always thought, my low risk fund called, extremely high growth, I didn't realize that thing was going to lose me money. You should have known that. And partly, around that, maybe your own reading, because that's important to do as well. But definitely, advisors should be telling their clients long before the time they actually sign on the dotted line that this is the kind of money you can expect to lose.
So what questions then should I be asking my financial advisor? Before we get there, maybe what are the questions they don't want me to ask them? Because that can always be fun when we start playing sort of financial advisor bingo and we see what makes them sweat.
So the question that makes me sweat most right now is what's the rand going to do in the next while? So we've got some clients who are not just asking that question, for fun, but they're potentially need to take forward cover for their businesses. They need to put some forecasts in for the rest of their financial year. And so, often a real question that has, massive implications for themselves, either personally or in their business. And so, they'll ask me, for example, where do you think the rand's going to be by the end of this year? And where do you think it's going to be in 12 months' time? And it's a really valid question to which no quality person can give a firm answer. There is just no sensible answer to that question. I can tell someone, I think the rand is really oversold. In other words, I think it's going to get stronger, but does it get stronger in a week, a month, a year? I don't know the answer to that. And I think so that's always going to be the toughest question in an environment like this. And I think the second question is, what's the market going to do? Is this the beginning of the recovery? Is this the bounce off the bottom? And I think it's a slightly easier question. Still the answer has to be, I don't know. But what one can say there is that, the likelihood is that it's going to bounce around at these levels for a while. It's going to go down for a bit at some point, and then once there's sort of a medical resolution to the COVID-19 around the world, that's when markets start to recover better. But for now, I think those are the two toughest questions: is what's the rand doing, and when are things going to get better?
Okay, so those are unreasonable questions because those are requiring a level of guesswork, and simply nobody can know the answers to those questions. What questions should I be asking my financial advisor? I mean, what is a reasonable set of questions?
Well, I think so. I think the one comment, just to stay on that for a second, is if someone's giving you forecasts with real authority and real conviction, that's a really bad sign in this kind of a time. And I think just, we've seen so many, there was that can I call him an idiot who was saying, don't take the COVID tests because, they're infectious. And there's so many of these videos going around with conspiracy theories and the like. So if someone's, giving you a strong conviction view on the rand or the markets, just be really careful of that. I think, good questions to ask are, let's look at the portfolio I've got. Should we make any changes? Now, I've spent most of this, this segment saying don't make any changes. So why would you? Well, sometimes, for example, if you've had a long-term investment, let's just say, you've been holding Naspers for 5 years and it's, you've got a massive capital gain even after the markets come off a bit, and you've been wanting to kind of find a way to reduce your exposure and get a bit more balance. Well, this might be a time to do something like that, because you can get out of a share which has done really well for you, but is costing you a lot of money from a tax point of view, and move into something which is potentially a bit more spread, a bit more diversified. So that's a great question to use. And then, for example, if you're trying to get a bit more balance in your local versus overseas investments, now might be a time where you say, well, let's look at what's losing me money as well as the things that are making me money. Do I use the time to do a bit of tax harvesting? In other words, sell investments that I'm not convinced are going to recover, potentially because, they're, just, silly examples, something that's in the tourism industry or something, that's an airline or something like that, where you just think, you own a cruise liner and you just think, well, I don't know that those things are going to recover over the next 5 or 10 years, but I do believe, cloud computing companies are going to do well, whatever the deal is. To sell something at a bit of a loss, to take the tax loss, and then sell other shares which are potentially still expensive, and to get some sort of a balance, that's a good set of questions to ask your advisor.